Today, we're diving into one of the most trusted savings options out there, the post office time deposit. We're going to cover exactly how it works, what kind of returns you can expect, and really help you figure out if it's the right move for your savings goals.
So, are you looking for a place to grow your savings that doesn't involve the stress of market ups and downs? You know, something simple, straightforward, with returns you can actually count on? Well, if that sounds good, then the post office time deposit might be just what you're looking for.
So what exactly is a post office time deposit, or TD? Honestly, think of it as your classic fixed deposit. You give the post office a lump sum of your money for a set amount of time. It could be 1, 2, 3, or even 5 years, and in return, they lock in a guaranteed interest rate for you. It's really that simple.
All right, so how do you get one of these? Sometimes getting started feels like the hardest part, right? But with this scheme, it's actually incredibly easy. Let's walk through exactly what you need to do to open your own account.
And here's the really great thing. The barrier to entry is super low. You can open a time deposit account with just 1,000 rupees. And while that minimum is nice and low, there's actually no maximum limit. You can invest as much as you want, which gives you a ton of flexibility.
The whole process really boils down to 3 easy steps. First, just get your basic documents together. A couple of photos, your Aadhaar, and your PAN card. Second, figure out how much you want to deposit, just remembering that 1,000 rupee minimum. And third, you can either pop into any post office to do it in person, or you can open it right from your couch using internet banking.
And who's this for? Well, it's for pretty much everyone. Any adult can open an account for themselves. You can open a joint account with up to 2 other people. A guardian can open one for a minor. And get this, even a minor who's over 10 years old can open an account in their own name.
Okay, now we get to the fun part, seeing how your money actually grows. Let's dig into the interest rates you can earn and the other sweet perks that come with having one of these accounts.
So here's the official chart with the interest rates for the latter half of 2024. Let's focus on the important numbers here. As you can see, the longer you invest, the higher the rate. For a 1-year deposit, you're looking at 6.9%. For 2 years, that bumps up to 7.0%. For 3 years, it's 7.1%. And for the 5-year deposit, you get the top rate of 7.5%.
Let's just pause on that top number for a second. 7.5% per year, and it's guaranteed by the government. In today's world, that is a very, very attractive risk-free return, especially if you're saving for something a bit further down the road.
Now, one of the most convenient things is how you get your earnings. You don't have to wait until the entire term is over. The interest you earn is paid out every single year, and you can have it automatically dropped right into your post office savings account. Super easy, totally hassle-free.
Oh, and there's a huge tax benefit to talk about, too. If you go for the 5-year time deposit, your investment actually qualifies for a deduction under Section 80C of the Income Tax Act. In simple terms, that means you can lower your total taxable income, which could literally save you thousands of rupees in taxes. That's a big deal.
Okay, but life happens, right? It's unpredictable. So it's totally normal to wonder, what if I need to get my money out before the term is up? Let's take a close look at the rules for early withdrawal.
All right, this is the most critical rule, so listen closely. There's a hard lock-in for the first 6 months. No matter what, you absolutely cannot withdraw your deposit during this initial period. So you have to be really sure you won't need these funds for at least half a year.
Now, after those first 6 months, you can close the account, but there are penalties. If you close it before you hit the 1-year mark, you'll only get the basic post office savings account interest rate. If you close it after 1 year, the penalty is a bit different. They'll calculate your interest rate at 2% less than what you signed up for. So for example, if you had a 3-year deposit at 7.1% and you closed it after 2 years, they'd recalculate your interest at 5.1%.
Because of that tax benefit we just talked about, the 5-year deposit has its own special rule. It has a much longer lock-in period. You can't close it before 4 full years have passed. If you do close it between year 4 and year 5, that same standard penalty applies. Your interest will be calculated at a rate 2% lower than the original 5-year rate.
Okay, let's fast forward. You've been patient, your term is finally up, and now it's time to enjoy the rewards. What are your options when the account matures?
You've got 2 very simple choices. First, you can close the account and get your original investment plus that last year's interest sent to your savings account. Or, if you're happy with how things are going, you can just extend the account for another term of the same length you started with.
But what happens if you, well, do nothing?
This is really important. If your deposit matures and you don't close it or extend it, the account stays open, but it stops earning that great time deposit interest rate. Instead, it'll just earn the simple post office savings account rate, which is only 4%. So you definitely want to take action when your account matures.
So let's wrap this up with the key takeaways. First, safety. This is fully backed by the government of India, so it doesn't get much safer. Second, fixed returns. The rate you get is locked in, no surprises. Third, simplicity. It's just so easy to open and manage, online or at any post office. And fourth, that tax benefit. With the 5-year option, you get to save on your taxes, which is fantastic.
So, the final question really comes back to you. When you look at its safety, its guaranteed returns, and its sheer simplicity, could the post office time deposit be that stable foundation your financial plan needs? It's a really powerful tool for anyone looking for security, but you have to decide if it's the right tool for you.